Behind me is DCB Bank Limited's Quarter 1 Fiscal Year 2026 Earnings Conference Call. And let's see some of the important things said in this conference call. Okay, so first, the person from DCB Bank, the management, this is a statement from them that they're very happy to inform that despite of the three rate cuts across this financial year. Now, what are these three rate cuts? So RBI cut the bank rate from 6.5 to 5.5%. So despite these three rate cuts from across this financial year, adding up to around 100 basis points reduction, 100 basis points is 1% reduction in interest rate. Their net interest margin reduction over quarter four was only 9 basis points. So 100 basis points reduction in the interest rate by the RBI, but the NIM reduction for DCB Bank was only 9 basis points. And so some good work has been done seriously on the cost of funds and on the cost of deposit front. So this 9 basis point, this small basis point reduction in NIM was only possible because of some good work being done on the cost of funds and the cost of deposit side. Moving on the improvement side, the slippage ratio, meaning the ratio of loans that have turned bad to the total number of loans, actually increased. So a higher percentage of loans are now becoming bad. It creeped up. And this is on account of three items, two of which were obvious and one of which was kind of surprising. So this rise in slippage ratio was due to three things, three items, of which one of them was very surprising. So two of the obvious things were a higher slippage on MFI, which is microfinance, and unsecured DA. So, first of all, before continuing, what exactly is DA? DA refers to direct assignment, which is when a bank sells a portion of its loans to another bank. It will sell a portion of its loans to another bank, and the money it will receive from the other bank for selling this loan, right? It will free up cash and liquidity. So that's a DA, a direct assignment. So there was a higher slippage on MFI, microfinance, and unsecured DA, meaning direct assignment, that is selling off some of the loans to other financial institutions, but these loans are not backed by a collateral. So they were both of which they were unaware of, and that is not a surprise, but they were aware of. So these two things, higher slippage on microfinance and unsecured direct assignment, they were aware of. Then what was the surprise was that the small ticket, that is a small size, the secured DAs, that is the direct assignments, the secured ones, backed by collateral, that they have taken a higher than normal flow into NPAs. So the secured direct assignment they have observed a higher inflow of NPAs from these NPAs of non-performing assets. So a higher than expected percentage of these DAs have become non-performing or have turned. That is the reason slippage have turned. Then moving on, we have some other information. Okay, this is the question being asked by an analyst, and the question is first on the asset quality. Okay, aside from MFI and unsecured DA, there seems to be an uptick in the gross non-performing assets ratio for mortgages as well. So he's saying that even mortgages, there's a higher uptake in non-performing assets. So is it the legacy mortgages in fiscal year 2023 where sourcing was not very good, which were flagged in previous quarter? That's the question. The next question is, and do we see the credit cost to be maintained around current levels at 60 basis points, or will it go back to 45 basis points to 65 basis points? Further, on the provision coverage ratio, it fell down by 3%. And so, is it just that all these expected provisions and bad loans, or is it something else? And these are all his questions. So, one is credit cost, and one is on the slippages. And last is on provision coverage ratio. So what exactly is the answer given? Answer given is the bank has accelerated provisions. Provisions are funds set aside to cover these non-performing assets. So they have accelerated provisions primarily on MFI and the unsecured DA and the secured direct assignment. So the secured DA frankly shows up in the mortgages. So mortgages, the gross NPAs increasing in mortgages is due to increase in secured DA, increase in the NPAs of secured DAs, which was unexpected. And these secured DAs are in mortgages. So that's why mortgages are also showing a rise in non-performing assets. Then, very important. So, if they had not taken accelerated provision, the credit cost would have been in line with what we have demonstrated in December 24 and March 25. And so it will be in the same range itself. And the reason why they accelerated these provisions, these funds, because they thought it would be more prudent. And he's not sure about the MFI recovery ability. So it makes sense for them to cover the exposure that we have through accelerated provisions in the beginning of the year itself. So to be more safe because of these rising NPAs, non-performing assets, BCB Bank has just increased its provisions, funds set aside, setting aside more funds to cover these more losses. And that's the only reason that credit cost has actually increased. And then, when asked about the guidance or the targets, future targets for credit cost, they have asked for the credit cost guidance and they have answered. The answer is that on the credit cost, what will it look like? Well, the future, it will neither be 60% nor will it be within the 45 basis points to 55 basis points. They expect it to be below 40 basis points. They expect credit cost to be below zero point 0.4 or at least equal to zero point 0.4, which is great because lower the credit cost, it just means more profitability. And then next portion, this is a different question, but still very important. This is concerning the non-interest income of DCB Bank. And here we're asking about the core fee income part. So the analyst asks the question, in terms of core fee income, while it is on a year-on-year growth this quarter, it has declined sequentially. Sequentially meaning quarter on quarter. So, and in the last 8 quarters, or there like for 7 quarters, it had a sequential expansion. So, for the last 8 quarters, the core fee income was rising quarter by quarter, but suddenly, when compared to quarter four of fiscal year 2025, the fee income in quarter one of fiscal year 2026 was lower than that of the previous quarter four. So why is it? He's asking, why is it? Is it like 135 crores this quarter or more like 160 crore, which was in the last quarter? He's asking what will the average fee run rate, the average future core fee income be like? So he's asking. So the answer is this. He does not want to comment on the immediate next quarter of what the core fee income is going to be. But it is important, now this is the important part. What is important that the core fee income has got third party distribution gains, it has got processing fees. Now, third party distribution gains is basically when DCB Bank sells financial products of other companies to its customers. Let's say it sells an insurance plan to a customer from like ICICI Insurance. So, of course, it will have a fee from there. And those are third party distribution gains. It's distributing third party products. And of course, loan processing fees. So, these are the two of the parameters for core fee income. And usually, quarter four has got a significantly higher contribution from third party distribution. And so the net dispersals in quarter one were less than the net dispersals in quarter four. So more loans were given out in quarter four. That is usual, resulting in the processing fees being of a lower nature because as less loans are given out, of course, the loan processing fees will be less. And the basic thing is quarter four, usually more loans are given out. That's just nature. That's nothing to do with the business quality. Just more loans are just giving out in quarter four. So core fee income becoming less in quarter one as compared to quarter four, nothing to be alarmed about. And further, the management says that the right indicator for to comparing core fee income is with the quarter, comparing the quarter with the corresponding quarter of previous year, so 12 months. And they're so core fee income, they're confident they should be able to grow in line with the balance sheet, or slightly less than the balance sheet. So if balance sheet grows like 20%, core fee income should grow like 17 to 20%, something like that. And secondly, treasury incomes and one-time incomes are not forever. So they have a solid plan, very important. They have a solid plan ensuring that trade-free income, trading free income, trade-free meaning without any selling of investment, selling of stocks, trade-free income, which is recurring in nature and sustainable, will over a period of time cover for the one-timers when they manage. So they're expecting core fee income to grow in line or slightly less than balance sheet. And whatever one-timers, let's say they sold a lot of investments, a lot of stock, and that showed up in the non-interest income, and that's like a one-time sale. That's a one-time income, won't happen again. They're saying that the core fee income growth should be able to cover all of that, or they're expecting it to. So very important. Moving on, we have the another question. Now, the analyst asks anything on NIMs. NIMs are net interest margins, of course. And the management answers that they are very happy with the way that they have managed net interest margins. Despite the yield going down by what you said, despite the repo cuts of three tranches by the RBI, there has only been a 9 basis points drop. So, will that continue? The management says they're doing what it takes on the cost of funds and the cost of deposit front, ensure that the net interest margin impact is minimized, and they're working continuously on it, and it will continue happening whether there is a future rate cut or not. And we're still growing the liability book by 20%, and we are still going to keep the top 20% well below 7%. So I guess that was it. That was some of the important stuff said. And yeah, hope you have a nice day.